Welcome everyone to the Nonprofit Association of the Midlands Guidelines and Principles e-learning series. The Guidelines and Principles cover legal compliance and best practices in all areas of nonprofit management and operations. We've built a website called guidelandandprinciples.org where you can find a wiki database with compiled research, background and information, and sample documents in each of these areas. Also on the website, you can take online assessments and immediately receive prioritized action plans based on your responses. If you've not yet been to guidelandandprinciples.org, we highly encourage you to do so. It's free and open to all nonprofits. My name is Todd, and this month we're exploring financial management with Mike McFarlin of McFarlin & Brockie PC, who will guide us through nonprofit audits, audit and finance committees, the Form 990, responsibilities of the entire board and financial management, and many other topics. Mike has been president of McFarlin & Brockie since 1992. The company provides services to dozens of nonprofits, and Mike himself has served on the boards of many Omaha nonprofit organizations, including Omaha Morning Rotary, Visiting Nurse Association, Omaha Home for Boys, and the Omaha Chamber of Commerce. His professional affiliations include the American Institute of Certified Public Accountants, the Nebraska Society of Certified Public Accountants, and Senior Partner Network. He passed his uniform CPA examination in 1976, so we know we're in good hands today. Before we dive into the presentation, I want to encourage you to ask questions or request clarifications throughout the presentation through the chat feature on the left side of your screen. Click Show Chat to enable and type your questions in the bottom left part of the screen. When Mike reaches a good stopping point in his presentation, he can address your question. Your identity will remain anonymous, so feel free to pose any question. For the record, we're recording today's presentation and we'll make it available to watch on our website with supplemental materials and further reading, and it'll also be available on our YouTube channel. Okay, Mike, I want to thank you for being here today with us to shed light on a difficult and essential subject for all of us. Would you tell us a little bit more about why you were compelled to present today?
Well, Todd, thanks for having me today, and I appreciate the opportunity to talk to you and your members of the NAM group. This is important information for all senior executives and financial people in the nonprofit world, and we're going to cover a lot of topics today, and we'll cover them rather quickly. So I suspect we'll leave a lot of questions out there, and the people that are listening today certainly have the opportunity to call me if they would like to discuss any specific questions that they have. So I assume my contact information is available during this presentation.
I will make it available to everybody afterwards.
Okay, great.
Yeah.
Well, let's start out then with our first slide today, and this is we're going to talk about an overview of general practices for nonprofit financial management. We've got about 5 topics to cover here, so let's just jump into the first topic, and that is obtaining a capable bookkeeper for your nonprofit. There's you know, some people will ask me, well, do I really need a full-time accountant in-house? And the answer to that is not necessarily. It depends on the quantity of transactions that you have. It could be that a part-time person would work just fine, and it doesn't necessarily have to be an employee. It could be an outside provider. So you might find that a person that would be willing to commit 4 or 5 or 10 hours a week to your nonprofit accounting would be perfectly sufficient to record all the transactions that are necessary. And that would be a very cost-effective way to record transactions and get the information that your board and that management needs. The providers, as you're interviewing or retaining a capable bookkeeper, should have some experience with accounting. I mean, it's not an area where you can say, well, my cousin was interested in math in high school and took a bookkeeping class, and now he wants to come to work for our nonprofit and do all the accounting work. You really need somebody with a little bit more experience than that, in my opinion. That person that I just described could be developed into a good, capable bookkeeper, but probably not without some training or under the tutelage of somebody else that had that knowledge. So you want someone that's got experience with QuickBooks, if that's the software you're using, or if you're using some other specialized software like Razor's Edge or some kind of fundraising tracking software, you would want them to have experience with that. Because if they don't have experience with that, you're going to end up paying them for the training time that it takes to get them up to speed on the software. Let's move on next to accrual accounting. There's always been a little bit of confusion about what is accrual accounting versus what is cash basis accounting. Cash basis accounting is very simple. It's cash, whatever cash you receive, you record it as income, or whatever the source of the cash is, and then whatever expenses you write, you record those. Accrual basis accounting is a little bit more comprehensive in that it considers items like pledges receivable in case you're doing a fundraising campaign and you want to record how far along you are. It would record bills that have not been paid yet but are due. It could record employee time off accrual. In other words, if you pay a benefit to your employees and you accrue time off for them, it would record that, and things like unpaid wages and that sort of thing. So the accrual basis of accounting is more comprehensive and actually gives a management and a board a better sense of where the organization is at a given point in time, because it's not just recording the cash in and the cash out. It's recording all of the transactions that are happening.
How does an organization decide which type of accounting, and if they are using cash right now and want to move to accrual, is it a painful process?
The conversion of cash to accrual is not necessarily painful, but it does require some consideration about the timing of when to record things. So, for example, if an organization was going to have a fundraising drive for some reason, they may say, well, we need to start tracking these pledges receivable on our records and make sure that we have those recorded so that we can follow up on them when they pledge to be paid. So there's not really a right answer about when to convert or whether one is more right than the other. Cash basis is the most basic form of recording. We do have some clients that still record on the cash basis just because that's what they're used to and that's what their board is used to looking at. So it's not that one's right and one's wrong. It's just that accrual will give a little bit more comprehensive information.
I see.
And really, so it depends on who the end user of the financial statements might be. So if it's a bank that's going to loan money against a building project, then they would want to see an accrual basis financial statement that would have pledges receivable on the balance sheet. If it's I guess I'm at a loss to think of some other example, but for example, if you had several employees and they were accumulating time off as they worked, and that liability was becoming large, it would be beneficial for the board and management to know the magnitude of that liability and how that was either increasing or whether they should take some action about limiting the amount of the accrual that could be recorded by an employee.
So being comprehensive, accrual can also affect the organization's ability to monitor and manage its other internal policies and procedures.
Yes, a cash basis financial statement and a cash basis reporting system will not give you the biggest picture of what's going on in your organization. It might be satisfactory, but it's not going to give you everything. Mm-hmm. Whereas accrual will give you more of the information that you need.
Excellent.
Let's move on to the next slide, Todd. Let's talk about the word GAAP. Some of you in the nonprofit world may have heard the word GAAP and not known what was being talked about. GAAP is pronounced like the clothing store, and it's an acronym for Generally Accepted Accounting Principles. You'll hear this a lot when talking to lenders or other finance people, and they'll say, we need financial statements prepared in accordance with GAAP. So what that would tell you then is that GAAP financial statements are using a set of standards which guides accountants that have been trained in preparing financial statements. So, for example, a loan to someone does not get recorded as revenue. A loan is an obligation that needs to be repaid. So that should be on the balance sheet shown as a loan, not on the income statement shown as revenue. Mm-hmm. And that is a very simple form of a GAAP requirement that accountants learn about as they're going through their training.
How does GAAP address things like, maybe grants or multi-year grants, or maybe just pledges?
Well, that's a good point, because there are numerous types of pledges. There are pledges that are unconditional, which are going to be paid to the organization regardless of what happens. Usually, conditional pledges are only based on a period of time. In other words, they'll say, I'll make a $50,000 contribution, $10,000 per year for the next 5 years. That's an unconditional pledge that is solely based on the passage of time. There can also be conditional pledges, which might be something along the lines of, I will give you $50,000 if you raise $50,000 to match it. Well, that $50,000 conventional pledge cannot be recorded as revenue until the first part of that condition is met. So you have a conditional pledge that will be deferred and will not be recognized on the books until the first part is met. There's also pledges for endowment funds and pledges for restricted projects. So you might have some of those as well as just general operating pledges.
And so GAAP does account for all of these different types of pledges or restricted funds or unrestricted funds.
Yes, GAAP gives some guidance to the accountants on how to record and report the different types of pledges and where they should be on their balance sheets.
Excellent.
I did put a note in there about that GAAP is not related at all to IRS regulations. The IRS is a completely different standard-setting body. Although they do follow some general principles of GAAP, they do not promulgate GAAP, nor do they necessarily have to follow GAAP, although they do tend to do that for the most part. So GAAP will also provide guidance for the presentation of the financial information and the disclosures. If you have ever had an audit or you have a full set of financial statements with disclosures, there are certain disclosures that are required by GAAP. For example, lease commitments, fixed asset addition policies, depreciation policies, notes payable disclosures, and so on. So there's a complete checklist of what should be included in a financial statement prepared in accordance with GAAP.
Is it important, going back a couple of slides, when choosing a bookkeeper, should they be familiar with GAAP and those principles?
Yes, they should have a basic working knowledge of GAAP. Mm-hmm. Yes. And that's why I indicated that someone who has just learned a few bookkeeping techniques may not have the tool set to be able to deal with all the variables contained within a GAAP financial statement. Excellent. Okay, let's move on to the next one. I wanted to have a little short conversation about monthly financial statements, because generally accountants like myself and our firm do not get involved in the monthly financial statements that are prepared internally and either given to board or management for review. Those monthly financial statements may or may not be presented in accordance with GAAP. In other words, there would be a very little reason to go through a calculation each month to determine what the liability for paid time off was. That's just not necessary to do on a monthly basis. Although you might want to record pledges as they come in, because that would be very important for the board to look at. So a monthly financial statement can be less precise, maybe a good word, less precise than an annual financial statement, because it is being used primarily by the board and the financial managers to run the organization. So that monthly financial statement may look significantly different than the year-end report that's prepared by outside accountants. Okay, let's move on to the next one. I put a slide in here about Sarbanes-Oxley because there's a lot of conversation about the best practices under Sarbanes-Oxley for nonprofits. And you may recall, this has been out now several years, but Sarbanes-Oxley came about as a result of the Enron and Tyco fiascos and the stuff that was going, shenanigans that were going on inside of their accounting records. So the Congress set up this this Sarbanes-Oxley committee to be a new standard-setting body for financial governance, primarily for directors and auditors and the preparation of financial statements for SEC registrants. So it was initially set up for SEC registrants. It has since been pushed down to what are the best practices for other types of entities. The private companies, privately owned companies, family-held companies have not endorsed the tenets of Sarbanes-Oxley as much as SEC registrants because it's very expensive and it's very time-consuming and duplicative in nature. In other words, there are multiple checks and multiple tasks that are done to make sure that internal controls are in place and things are being done properly. That's usually not available in a smaller organization, whether it's for-profit or non-profit. It's just too time-consuming. A couple of the tenets of Sarbanes-Oxley is that they encourage the use of whistleblower policies. I know a lot of bigger nonprofits have outside services like Ethics Point to use for their whistleblowing monitoring of that employees can report, and then that information gets distributed out and followed up on usually by board members and senior management. Sarbanes-Oxley also directs an organization to have a written record retention policy. So if you remember about the genesis of this Enron problem was that Arthur Andersen was shredding and destroying documents, which was their downfall. So this written record retention policy was deemed to be important, and it directs board members to disclose potential conflict of interest situations. And I would imagine most of your members probably have a written conflict of interest policy. They do, or we encourage them to do so. In fact, Sarbanes-Oxley, while it had most of its implications for publicly traded companies, it's also the basis for this Guidelines and Principles program. The Senate Finance Committee approached the independent sector after the legislation came out and said, now what's the nonprofit sector doing in terms of self-regulation and governance, and is there a set of best practices in place so that the sector can remain more self-regulating and so that the federal government wouldn't have to put down some kind of one-size-fits-all for the management of organizations. And so that's really the basis for this series and for all the resources we're building. Okay, let's move on then to the next one. The next slide is a little discussion about finance and audit committees. I have a few slides that relate to that. Let's go to the next slide. The role of the nonprofit board and the relationship with the board. The role of the finance and audit committee in a nonprofit board should be separate if possible from the rest of the board and the rest of the committees. Now, that in practice, that's a little harder to do than it is in theory because it's generally hard for a nonprofit to get a qualified finance and audit committee member on their board, and if they do, they're probably the only one that is qualified. So it could be a committee of one with maybe the chairman of the board as the other committee member, and then that finance and audit committee board reports to the main board, and they do have specific functions. Let's flip to the next page, or the next slide, Todd. Okay. Let's talk first about who who would be a qualified person to be on that committee. We'd want either a CPA that's in public practice or industry. That would be an ideal candidate for that position. Maybe a knowledgeable investment advisor who has some knowledge of reading financial statements and has some knowledge about investments, or business owners. Sometimes business owners are capable of filling that role because they've dealt with banks and their own financial statements. So it doesn't necessarily have to be a CPA, but it should be someone who's familiar with the reading and interpretation of financial statements. Next slide. The relationship of this Finance and Audit Committee with the internal bookkeeper and the executive director and the auditor is sort of a triangle. The Finance and Audit Committee supports the bookkeeping function, answers questions when necessary. They can help with the budgeting and planning process. It gives some guidance to the internal staff on budgeting and planning. They can be responsible, they are responsible, they're solely responsible for interviewing, selecting, and retaining the outside CPA firm. So that the CPA firm's responsibility is to the Finance and Audit Committee, not to the nonprofit executive and the staff. That's somewhat of a little bit of a disconnect for some nonprofit executives, because it feels like the auditor should be reporting to them since they're getting their bill paid by the nonprofit. But that's not the case. The auditor is required by our standards to report to the Finance and Audit Committee. So anything that we might find or might need to discuss would be discussed with the Finance and Audit Committee if it was of a significant nature. Did I cover that well enough, Todd? Do you have anything else you want to talk about on Finance and Audit Committees?
I think that's fairly clear. And what what have you seen on boards that you've served as sort of a good, sort of healthy and appropriate relationship between the Finance Committee and the Executive Director? How do they communicate, and what what are they talking about when they meet? What are they doing together? Well,
that relationship is certainly not an adversarial relationship. The Finance Committee should be in a cooperative role with the executive management staff of the nonprofit, and should be willing to help, because that's why they're on the board. They're on the board to help. They're not on the board to be a hindrance or a stumbling block. But they are also a buffer between the auditor and the executive director, so that if there are things that the auditor wants the board to be aware of, that auditor will report directly to the Finance and Audit Committee. Usually that stuff is resolved and never gets elevated to the level of the Finance and Audit Committee having a problem with the auditor is generally not the case, and the auditor having a problem with executive management is generally not the case. It's usually, if there are any misunderstandings or miscommunications, those are resolved. Might be reported to the Finance and Audit Committee, but they're generally resolved and are most likely benign types of issues. But if the auditors found evidence of fraud or some sort of evidence of misappropriation of funds, they would be required to go directly to the Finance and Audit Committee and report it, regardless of what the executive director told them to do. So there can be situations where they're adversarial, but 99% of the time it's not that situation. Okay, let's move on to the 990. We're sure covering a lot of topics here, but the Form 990 is the annual IRS reporting form, and the 990 is an interesting document because it's informational in nature, and it reports a lot of information. It's generally done by the outside accountant. It's generally submitted within 5 or 6 months of the year end, so there's plenty of time to prepare it. But it's also available to the public with a few exceptions. So let's go to the next slide. The 990 is generally prepared by the outside CPA firm. There have been some that are done by internal staff, but I guess I probably wouldn't recommend that. And I'm not being self-serving there. I'm just saying that if you're only doing one a year, you're more likely to make a mistake than if you're doing several a year, and or many a year, like we're doing many 990s a year. And we know what they should look like when they're done. Whereas if a person who's only doing one a year may say, I'm not really sure what this question means, but I guess I'll just take a guess at it.
So if you have, if an organization has an outside bookkeeper that they contract out 5 to 10 hours a week, would that bookkeeper be qualified to fulfill the 990, or would that bookkeeper need to pass on the financial information to a CPA firm?
I would say, Todd, that that internal person would probably know within themselves whether they were qualified to do the 990. Accountants are so conservative in nature that if they don't know how to do something, they will generally say, I really don't know what I'm doing. They're not going to try and bluff their way through it if they don't know what they're doing.
Excellent.
And so if a person internally said, sure, I can do the 990, that's no problem, and if I need any help, I'll just look in the questions and answers and see if I can figure it out. Well, then I would say that person has probably got a pretty good shot at getting it done right. If somebody else said, I've never done one, that would be a red flag to know that they shouldn't probably be doing one. Okay, one more point on the 990. Most of the information in the 990 is public information, and there are services out there that publish this information. I think GuideStar is one of them that I'm familiar with.
Yeah, we actually have a website that publishes all 990s for registered 501c3s in Nebraska and 14 counties in western Iowa at midlandscommunitycompass.org. So if you're curious about an organization that you're volunteering for, or you've been asked to serve on the board, I mean, you can obviously always request to see those documents, or you can go find them online.
All right, let's hit the next slide then. On Form 990, best practices involve answering the questions about the activities, events, and fundraising. There's a lot of narrative that goes into the 990, and these next two slides will discuss that, but the largest part is answering the questions, and really the accountant may not be the one that is best qualified to respond to those questions. They'll ask, and I know in my own practice, for those questions, I will sit down with management and say, now let's figure out what this narrative should be. So there's a lot of information that's in there that is not numbers driven. So let's go to the next slide. The second page asks for specific information about programs and activities in several paragraphs. And since this is public information, I feel like that narrative is not given enough attention in some organizations, because it's either done by the outside accountant who is making up or interpreting their own vision of what the organization's about. And it should be done more by management and given more thought to those paragraphs on that page. The other information that's in the 990 that is helpful to an outside person is looking at things like the percentage of your fundraising and management and general expenses to your total budget. So if you've got a $100,000 budget and you spend $50,000 on fundraising, you know, that's not a very favorable ratio. It should be more like combined management and fundraising, maybe 25%, 75% being spent on program and activity functions. So those types of disclosures can be found out at your website when they look at people's 990s.
Another thing we'll do when we post the recording of this presentation is there will be some supplemental materials, and one of those will be a diagram, kind of an illustration put out by our counterpart in New York City that basically dissects the 990 and helps you look at item by item, you know, line by line, and understand what you're reading and maybe how to understand some things that are going on in an organization by looking at the 990.
All right, that covered the 990, Todd. Now, I thought it might be interesting to have your listeners, and we haven't gotten any comments yet back, have we?
It's been a quiet field.
Yeah,
they're absorbing your
wisdom. Either that or they're all asleep, right?
I doubt that.
Let's talk for a second about audits, compilations, and reviews, because they are different reporting standards. You may have, nonprofit executives may have had a situation where their board has said, we're getting to the size where we need an audit. Okay, and that's just a general comment. We're getting to the size where we need an audit. Or we've had a grant that requests a copy of our audit. We're going to prepare a grant request and they want a copy of our audit. Or we're going to acquire a building and we have some money for the down payment, but the bank wants an audit. Okay, that's just sort of a in that category, or in those phrases that I used, the word audit is being used as a descriptor for a financial statement, right? Mm-hmm. So it's not that some other type of financial statement might work in that case. It's just that audit is used as the general catch-all for a financial statement. So actually an audit is the highest level of reporting. A review is the second level, the middle level of reporting, and a compilation is the least level of reporting. The least, when I say least, I'm talking about least complicated and least expensive. So an audit involves a lot of things. Review involves a medium amount of things, and a compilation involves a little amount of things.
So in all of those instances that you mentioned where someone might require an audit, might they also, you're saying they might also accept one of these other versions, or are they being specific about needing that highest level?
No, Todd, what I'm saying is exactly what you said, that if you were writing a grant and you sent a copy of your compilation report along with that grant, the person reading it at the other end might not know the difference between a compilation and an audit. And so you have satisfied them by providing them with the lowest level of reporting and not incurred that additional cost. Now at the next slide, I put a link in there to a chart from the American Institute of CPAs that gives a comparative overview of the differences between an audit, a review, and a compilation. So there's a lot of detail there about what technically it is and what standards the CPA is held to for an audit versus a review or a compilation. And in an audit, the auditor has to look at internal controls, has to evaluate internal controls, has to test internal controls. Internal controls are things like bank reconciliations and making sure the transactions are recorded properly and accurately. In a review and a compilation, those things don't have to be tested. So in an audit, you can immediately tell that they're going to be more expensive than a review. Because
they want to know who's checking the mail, and when there's a check, what happens to that, and they want to know all those steps.
When someone opens the mail, how does a check get handled? Or when somebody processes payroll, who approves the hourly rates and the number of hours on the time cards and that sort of thing. So there's some tests that go along with the actual financial reporting. Will it catch everything? Probably not. If somebody is stealing some pens out of the supply closet or putting down more miles on their mileage report than they should, it's not going to catch that stuff. But what it does do is it tests the controls to make sure that if somebody who is writing the checks and making the deposits is not the person that's reconciling the bank account, so there's two different people involved in the accounting functions, that's being done properly.
So I think when people hear the word audit, they assume that it's like an IRS personal audit, where they come and they want to see all the receipts, and they're going to monitor every which way that money's moved in and out of particular accounts, or how you're managing your finances and reporting your income and all of those things. But this is a little bit different than that, and it won't necessarily catch the kinds of things that an audit that we're more familiar with will.
Well, generally, two comments on that, Todd. Number one, in an IRS audit, they generally are not under any kind of time constraints. They are working on our tax dollars, so if they feel like they want to spend 4 or 5 extra hours looking at your mileage records, they don't have any compunction about doing that. For auditors that are auditing nonprofit organizations, typically we are under time constraints because the audit is a fixed fee audit. So we have allocated certain amounts of times to certain activities to stay within that fee structure, and we have a concept that is called materiality. So if an item is immaterial based on the thresholds that were set at the beginning of the audit, typically we're allowed to pass over that or to not spend a lot of time on it. We might spend a little time on it, we're not going to spend a lot of time on it if it's immaterial. If it's a material item and it appears to be a problem area, then we will spend the time on it. If it's not a problem area, again, we'll audit it, we'll test it, and if it looks like it's being done right, we move on, do the next thing. Okay, so, and then at the end of an audit, we provide an opinion to the financial statements that they've been prepared in accordance with generally accepted accounting practices, and that we have applied generally accepted auditing standards to those numbers, and we found nothing that should be changed. So we give a clean opinion then at the end, typically, of the audit. Okay, so what does your organization need? Does it need a compilation, a review, or an audit? And you probably need to look to your Finance and Audit Committee for that decision, because in my opinion, a lot of nonprofits could get along just fine with a compilation, yet either the board or some donor or some grantor has said, well, we really need an audit for this level of contribution. If that's the case, there's really not too much you can do about it. You're going to have to do it.
What are we talking about financially speaking, or the cost of performing any of these?
Boy, that's all over the board, Todd. But a compilation might be. I'll just use some relative numbers here. A compilation might be $1,500. A review might be $4,500, and an audit might be $9,500. So that might be the relative scale of the amounts that would be involved for the same organization. So you can see that compilation is much more financially efficient if that's all that's required by a donor or a lender or a grantor to get the financial information necessary.
Much easier to come up with $1,500 every year than or what have you than $10,000.
And again, size may make a difference. It's very tough to have a audit of a 4-employee organization because there's just not enough separation of duty. The 4 people are sitting there in the same room doing the work, and if Larry goes to lunch and says, well, go ahead and reconcile the bank for me while I'm gone, that was part of the internal controls. That Larry does the bank reconciliation. That if he's not going to do it, then that's a breakdown in controls. So a larger organization is probably more likely to need and want an audit than a smaller organization. So a $5 or $10 million budget organization would most likely have an audit, whereas a $50,000 to $100,000 organization probably just needs a compilation.
Sure. And so I see also on your third point there that some organizations, if they're small enough, could get by just with the 990, that there's enough information there for people to understand or do some level of due diligence with the organization.
Yeah, 990s provide all that information to the public, so if a donor or a grantor or a lender will accept a 990 because that financial information is there, that's certainly another cost-effective way to get financial information out to the public.
Excellent.
Okay, let's move on. And the last comment I'll have, second to the last comment I'll have on the various levels of service is, as a general rule, it's not cost-effective to switch back and forth between audits and non-audits. It's once the auditor is set up to do the audit and to apply the testing that's necessary for an audit, it's just really not that, in my opinion, it's not that efficient to switch back and forth between an audit and a non-audit. In other words, some nonprofits might say, well, let's just get an audit every third year. That's really not too cost effective, in my opinion. You're going to have a problem because the auditors want to know what are we doing on an annual basis, and then what kind of liability do we have in those 2 interim years when we didn't do the audits, because the auditors are on the hook for audited financial statements on those 2 outside years. What about the 2 inside years if fraud occurs? Mm-hmm. So I just don't think that's a good mix to be switching back and forth.
Yeah, so if you were to say, we'll do an audit every 5 years, and we'll just do, a review or a compilation in between to save ourselves some money and get by, you think that's
I don't think that's necessarily a good thing, because certainly the financial accounting staff knows that in those 2, every 5 years, those 2 periods are going to be audited. But in the meantime, they've got 3 or 4 years of no controls, mm-hmm. and no testing of controls, and it's a free-for-all. If somebody wanted to steal some money, they would steal it in the 4 years in between, mm-hmm. if it was a big enough organization. Now, most people are honest anyway in the Midwest, so I don't worry about that too much. But there have been some cases of theft and fraud, and so I just don't think if you need an audit, you need an audit. You shouldn't go back and forth. Mm-hmm. That's my opinion. Now, let's get specific on a couple of terms about audits. We've already talked about what they don't tell you. And go back though, Todd, if you would, please. I'm sorry. Sure. There are 2 points on there I wanted to make. There's a concept of independence that is very important in our world, in our auditor world. Independence is the concept that we don't have any relationship with you, and we are not influenced by your board or your management. So, for example, if my dad was the executive director of an organization, I would be precluded from auditing that organization because I would not be independent with respect to that organization. Mm-hmm. Okay, so we take that concept of independence very literally and very importantly, so that we make sure we're independent when we're auditing someone. And then you asked me a question a while back about the best practices debate of rotating auditor firms versus other alternatives. And I said that one concept that has some merit is to retain the same firm to do the audit because you have the institutional history within that firm, but perhaps an alternative to rotating auditor firms is to request partner rotation so that there's the same firm is doing the audit, but a different partner is in charge of the audit, and that can satisfy the Sarbanes-Oxley requirements as well.
What are some of the advantages to that? I assume institutional memory is in there.
Yeah, institutional memory is a big one in my opinion, because if you got audited by the IRS 10 years ago and you switched audit firms 5 years ago, that new audit firm isn't going to have any institutional history relating to that IRS audit and what went on and what they recommended or what they found. So personally, I think that institutional history and retaining the audit firm is important, and if you have a concern about Sarbanes-Oxley issues, request that you have a partner rotation policy in place on your account.
When we first discussed this a while back, you talked also about document retention as part of that institutional memory and sort of the way auditing firms maintain their records as long as their clients are current.
Right. If you start with a new audit firm, you're requiring them to build all new files of old information, things like exemption letters and bylaws and minutes and that sort of thing from years past. So there is some inefficiency in the first year or two that a new firm takes over, and that does not occur if you retain the same firm.
And if a client leaves a firm and goes to a new person, will that, I assume the old firm will not maintain its records for very long?
Usually there's probably a five-year window that those records would be retained, but not much beyond that.
Okay.
Yeah. So in my example with the audit 10 years ago, by the time if a 10-year problem came up, those records might be gone from the first firm as well.
Mm-hmm.
So, okay. Well, let's move on. So we're still talking about audits, and an audit is a set of procedures. We've talked about this, I think. Sure. Materiality, we've talked about that. Testing of internal controls. The only thing I hadn't talked about was audits will not prevent or detect fraud if two or more people are involved in it. So typically internal controls are designed to have one person doing something and another person either checking it or verifying it. And if those two people are in collusion on perpetrating a fraud, that's an override of the internal controls, and the auditor won't be able to catch that because the records will be dummied up to the extent that it looks like the work's being done, but it's not. Okay? And then the next slide talks about independence. We talked about that. Independent in fact and in appearance. The second point there is that if you have your CPA firm be the outside contractor to do your monthly statements, they're probably not going to be able to jump over the independence hurdle and be able to audit that same work at year end, because they would in essence be auditing their own work, and that's not something that we're allowed to do. So be aware of that. If we've had cases where nonprofits have one CPA firm doing the monthly work and another CPA firm doing the year-end work as a counterbalance to that second comment. And then typically a CPA in a public practice cannot participate as a board member or be on the finance and audit committee of an organization that it audits. And we talked about audit rotation. It's not necessarily required that you rotate audit firms, but you could rotate audit partners within the same CPA firm to accomplish most of those desired results and retain the institutional knowledge. And I think that's the end of our formal comments. We don't have any questions yet, Todd, that I can see on the screen anyway.
I don't either. So we've come to the end of the presentation, and we've covered a lot of ground, talking about audit and finance committees, the difference between a compilation, a review, and an audit, some accounting best practices, how to find the right bookkeeper, and some questions to ask. And we started to look into the 990 and what kind of information it provides and who is best suited to prepare the 990. I'd like to open it up to everyone out there to see if you have any specific questions about any of those topics. Anything that might be, pertinent to your organization right now, or maybe you're serving on the board of an organization and you're wrestling with some of these topics. Okay, so we've got a question coming in. The question is, as a grant manager, what should I look for in an audit that might tell me there is trouble?
Well, first of all, you need to look at the audit opinion, which is probably one of the most overlooked pages in the audit report. The audit report contains a lot of financial information and a lot of disclosures, but the very first page should be the opinion. And that opinion will generally state that the auditor doesn't have any problem with the presentation of the financial statements or the disclosures. If that's the case, if that's a clean audit opinion, then you can move on and say, okay, now I need to be concerned about probably if you're a grantor and you're giving the money out, you want to be concerned about a couple things. I would guess that number one, they're going to perform the services that you ask for in the grant, and I guess that you just need some kind of follow-up process on that. I don't know that there's any place to look that would tell you there's trouble unless it said so in the opinion.
For is there something maybe even in the monthly financial statements that might be more valuable to a grant manager if they're trying to track how funds are being spent, or if they're on target, especially if they have restricted funds? And is that something that is that information that should be available to staff? I mean, we kind of talked about the finance committee and the executive director going over monthly financial statements, as maybe at a finance committee meeting or even a presentation at the regular board meetings. But for someone like a grant manager, how can they make sure that their grant is being managed like the way that they think it is?
Well, if I was the executive director of a nonprofit, I would probably be very reluctant to allow anyone outside the organization to look at the monthly financial information, because it's just not going to be as accurate and as detailed as the year-end financial statements. Mm-hmm. So if someone was going to rely on those monthly statements that we were using internally to manage the organization, I would be very skeptical about whether they were interpreting those in the same manner as we were internally interpreting those items. So I would say the answer to that question would probably be that would be information you would not be able to get, mm-hmm. as a general rule. Now, as far as are they administering our grant properly, that's like a $64,000 question, right? I mean, you just have to have some trust that they're going to be able to do that. And I suppose one of the things you could ask is, what kind of internal controls do you have over things like where our expenditures are going, who's putting the time on this project and being charged to this project, and what are the controls relating to their time records and that sort of thing. But if it's a grant where they're just turning around and paying the money to somebody else, that's a fairly easy grant to administer, because you just ask for copies of the checks or whatever they paid for. If it's a matter of internal staff spending time on a program, that becomes a little bit more difficult. But you could still ask for specific time records or who the employees were that were working on that. And I would imagine you could talk to them directly if you wanted to.
Mm-hmm. To the grant manager, have we answered your question? And I'd also like to open it up to the rest of the group. Looks like we've answered the question. Okay. Well, I don't see any new questions coming in. I assume that we have covered everything and everyone is ready to go out and excel in financial management, and hopefully we've planted some great seeds today that will keep you exploring best practices. Mike, do you have anything that you would like to add?
Well, you see my contact information on that last slide there, so if you have any specific questions, feel free to give me a call at that office phone number and ask them. But yeah, appreciate the opportunity to be here with you today, Todd. Thanks.
I really appreciate you covering some of these difficult topics. I know it can be hard to go out on the internet and find these things and and get a straight answer. Sometimes you can ask around to your colleagues in the nonprofit community, but it seems like every organization has its own way of doing things depending on its size and mission. And so I think it's really helpful to have a basis here for understanding how to approach financial management in an organization. So Mike, thank you very much for providing that.
You're welcome.
And I look forward to working with you in the future.
Thanks.
Thank you, everyone.